Alrighty. So in today's video, I'm going to be sharing with you the top 3 stocks for the wheel strategy. So these 3 stocks are all under $200. So if you don't have that big of an account, you can definitely wheel the stocks as well. Now, before I actually get into the stocks, I want to first share with you the 4 golden rules for how I select the wheel strategy stocks, right? So these are the criteria. So generally when I choose stocks for the wheel strategy, I want to choose stocks where at least I think that there's a higher probability of it going up once I enter into the stock rather than, be held in this underlying and be trapped there for years and years on end, right? So there are 4 golden rules. And the very first rule is that the company has to be profitable, right? So for me, this is a very important one because when the company is profitable, then at least the chances of it going bankrupt is not that high, right? Because there are companies that people have traded the wheel strategy on and then it just went straight to zero, right? Because the company is not even making money. They're trading it mainly because it's very high volatility. So I like to take a different approach because if you were to get into the wheel strategy, it's going to be pretty capital intensive, right? Because the whole idea here is for you to actually get into the stock position, right? If you're going to get assigned, then there's going to be a hefty capital intensive investment. So I want to make sure that if the company is profitable, at least there's a chance that the company can still, over time, the stock price will go up. Now that's rule number 1. Now rule number 2, the company has to generally have increasing revenue and profits over the past few years. So what I found is that when a company generally has increasing revenue and profits over the past few years, that also kind of reflects in the stock price as well. Because remember, every single stock that we are trading is actually a company, right? So if it's a company that is doing well, it has been making money, generally that also reflects in its share price as well. And what you find is that if you find a company that do not actually have increasing revenue profits, in fact, they have increasing losses over the years, you will also find that their share price is very erratic, right? Up and down, right? One of those stocks are like AMC. So those are stocks I generally stay away from. Now, rule number 3. So this is to make sure that I have a margin of safety, and that is to see that the stock is at least undervalued at that point in time when I want to enter for the wheel strategy. So you might get into a underlying where the company is profitable and that it has increasing revenue and profits over the past few years, but it might be overvalued. So if the stock is overvalued, then there is a chance whereby once you enter into the wheel strategy, the stock might suddenly just plunge, right? Go back down to its value, and then you might be stuck in that position for quite some time. So definitely, I want to look out for one, right? At least to err on the safe side, to find an underlying, a stock that is undervalued. And I'm going to share with you later on how to find out whether it's undervalued or not. And finally, rule number 4 is strong technicals. So basically, strong technicals is you take a look at the chart, right? The company has to be around for quite a number of years and have gone through a number of market crashes, right? Basically, the major crashes, and it has survived the market crashes, and each time it has come out of it making new highs, right? So for me, this is also important to know the durability or how strong this company is during market crisis. Okay, so these are the 4 rules. Okay, so now let's get into the stocks. So the very first stock is none other than Alphabet, right? So Alphabet, the ticker symbol is Google's, right? GOOGL is the Class A shares. You can also go for the Class B shares. There's GOOG. So at this point in time, Google right now, or Alphabet, is at $165 thereabouts, right? At least as of this recording. Now, let us see whether Alphabet actually meets the 4 golden rules which we have defined just now. So rule number 1, company has to be profitable. And as you can see over here, Google is profitable, or rather Alphabet, right? As you can see, the net income is 73.8 billion and the net profit margin is 24.01, and this has increased from the previous year. So Alphabet definitely has met rule number 1. Now, what about rule number 2? So rule number 2 is that the company generally has to have increasing revenue and profits over the past few years. And as you can see, since 2019, Google has had increasing revenue. And as for the net income, generally has been increasing over time as well. Now, of course, there's an anomaly at 2021 most likely is because due to the fact whereby, after the pandemic, a lot of businesses start to, shift their marketing more towards the digital side, and they start to use more of Google services. As you know, a lot of their business comes from the ad revenue, and also a lot of people start to, watch a lot of online videos, right? Most particularly during the pandemic time, right? Everybody's stuck at home, and then they're just watching YouTube. And as you can see, as a business, this company, Alphabet, is doing very well. So definitely it has satisfied rule number 2. Now, rule number 3, undervalue. So as you can see over here, this is the website of Simply Wall Street. So there are quite a number of websites that you can go to that actually, shares what they think is the fair value of the stock. So you definitely want to go to a few of this, take a look at them, and then just have an aggregate of all of them. And you could even discount some of the values that they give, right? Just to give you an even more margin of safety. So as you can see over here, based on Simply Wall Street, the fair value of Google, or rather Alphabet, is $253. And as of this current price of $165, it is currently undervalued, right? So at least we know that there is going to be some chance of the market going up at this current price. And as you can see over here at the bottom, it says that Google is significantly below fair value, right? You can see Google is trading below fair value by more than 20%. So when I see a company which has rule number 1, rule number 2, and rule number 3, and it is really undervalued, then this is actually a very good candidate for us to do the wheel strategy. And finally, rule number 4, it must have strong technicals. So the company must have gone through market crashes and has made new highs each time. So does Google satisfy this criteria? Absolutely, right? As you can see over here, Google went through the financial crisis in 2008. The market actually went down quite a bit. But as you can see, based on a very broad perspective, right, for the past 10 plus years, you can see that this drop down here doesn't even look like much, right? But at that point of time, that was a really big crash, right? But as you can see, market has since recovered over time and has just made higher highs, right? Even in 2018, right? 2018, thanks to Donald Trump, we have the trade war. And then 2020, we have the pandemic. And then in 2022, thanks to Mr. Putin, where he put in his troops into Ukraine and caused the worldwide inflation, which caused the markets to really come down. Right, as you can see, during all these market crashes, Alphabet managed to come back up on top and then made new highs again, right? So Alphabet definitely fit the criteria of having strong technicals. So in my opinion, Alphabet is definitely a good stock to wheel, and I have been wheeling Alphabet for quite some time now, and it's been doing very well for me. Now, the second stock is Amazon, right? Amazon, as of this current recording, is about $186. So does Amazon fulfill the 4 golden rules as well? Well, let's take a look. So rule number 1, is the company profitable? Well, it is, right? As you can see over here, net income, 30.43 billion. And net profit is 5.29. And as you can see over here, there has been a very big jump in the profits, right? The net income and the net profit margin over 1,000%. Now, what about rule number 2? Does Amazon have increasing revenue and profits over the past few years? Well, so as you can see over here, based on the revenue, the blue bar, it does have increasing revenue. But for the net income, you notice that it was increasing until 1 year, 2022, there was actually a loss. And the loss is really because of an investment which they did into the electric automaker, Rivian, which, suffered, a very big decline in the share price, I think about 80+%. So that was the only big reason why there was this negative income down there. But after that, in 2023, as you can see, it recovered and it did pretty well. So rule number 3, it has to be undervalued. So is Amazon undervalued? And as you can see over here, it is significantly undervalued as well, right? According to Simply Wall Street, as you can see over here, the fair value is $336, and at the current price of $186, it is undervalued. In fact, according to Simply Wall Street, it's 44.6% undervalued. Now, if you want to have a little bit more conservative value, you can definitely take 336 and then you have a discounted value of that, right? Maybe you discount it by 10% and so on. Even though if you discount it, you're still going to find that the current price is still undervalued. So rule number 3, it has passed this criteria. Now for rule number 4, does Amazon have strong technicals? Well, it clearly has. And in fact, Amazon has gone through the most difficult period for any tech company, and that is 2000, right? The year 2000, that was where the tech stock crashed. There was this internet bubble where a lot of company actually went bankrupt, right? A lot of company no longer are listed, and Google didn't actually went through that time because it was only listed sometime in 2004 or 2005. But Amazon was listed before the dot-com bubble, right? So it went through the dot-com bubble as a young company. It survived that, and in the end, it went even higher in terms of the share price, right? So as you can see, Amazon definitely is a very strong company in terms of the technicals, and I would say it's a good candidate for the wheel strategy as well. Now, finally, the third and final stock is Palantir. So Palantir at the moment is currently $37.20 as of this recording. So does Palantir actually meet the 4 criteria? Well, let's take a look. By the way, if you like this video so far, please subscribe and also click the thumbs up button. And also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So first of all, is the company profitable? Well, as you can see over here, as of 2023, Palantir is profitable, right? It has a net income of 209 million thereabouts and a net profit margin of net 0.43, and it has increased from its previous year. So rule number 1, the criteria has already been satisfied. It is a profitable company as of 2023. Now, what about rule number 2? Does it have increasing revenue and profits over the past few years? So Palantir, unfortunately, does not have rule number 2 criteria fulfilled, right? Because as you can see, for the years from 2019 all the way to 2022, it was actually still in a loss, but it does have increasing revenue. So why do I still select Palantir as one of the wheel strategies? Well, first of all, I would say Palantir is a little bit more speculative, but it actually, I would say, it has potential to start to do very well in the long term, because even though it was losing, at least from this point from 2019, 2022, you can see from 2020 onwards, the losses has been getting smaller and smaller until a point in 2023, it finally turned a profit. And it has been increasing revenue. So I definitely do think that Palantir has a good potential to do well in the long term, as long as the company continues to be profitable. So if you were to actually take a look at the quarterly income statement, you will see that it's actually doing pretty well, right? Quarter on quarter, as you can see, since June 2023, you can see that the net income has actually been steadily increasing along with the revenue. So again, like I mentioned, I do think that Palantir do have the potential to be increasing over the next few years, but it's a little bit more speculative compared to Amazon and Google because it's not as established, right? At the moment, it's a relatively new company compared to them. It has not withstood many of the past market crashes, but at the moment, I do think that it does have some potential. So rule number 3 is Palantir undervalued. So as you can see over here, according to Simply Wall Street, the fair value of Palantir is $51.80, and at the current price of $37.20, it is 28.2% undervalued, and always a good thing for us to see that it is significantly undervalued. And as you can see over here, Simply Wall Street has mentioned that it's significantly below fair value, which is by more than 20%. So it passes rule number 3. Now, what about rule number 4? So as you can see over here, like I mentioned, Palantir is a relatively new company, so it doesn't have that strong of a technicals compared to Amazon or Google, but it did go through 2022, right? As you can see over here, it went down. But then now it has broken the high of where 2022 once was, and then it has shot up, right? So I do think, again, Palantir is a more speculative stock, but I do think it has some good potential. So if you do want to wheel Palantir, I would say a smaller allocation compared to Amazon and Google. Okay, so now that I've shared with you the 3 stocks for the wheel strategy, I'm not just going to stop there. I'm going to share with you how and when to enter into the wheel strategy for these stocks, right? So how do you get into the wheel strategy? So there are 2 methods for this. So the very first method is the traditional wheel strategy, which basically is what everybody is doing, right? So basically, the traditional wheel strategy is a single entry mechanism, right? You enter it one time, wait until you get assigned, and then once you're assigned, once the market goes back up, you sell the covered call again, right? So how do you get into it? So since it's going to be single entry, I do think that the timing is a little bit more important than the next method, which I'll share with you later on. So for this, what I like to do is that I want to wait until the stochastic is in the oversold territory before selling the cash secured put. So remember, we already have 4 rules in our place, the 4 golden rules. These 4 criteria has really helped us choose an underlying that we know that at least has the potential for it to go up in the long term. So right now we need to identify the timing for this. So for this, the timing is that we want to wait until the stochastics, as you can see over here. By the way, this is the slow stochastic. A number of people have asked which stochastic this is. So we want to wait for it to actually go down into the oversold territory down here, and the price would most likely come down. And then at that point of time, then you can start to sell the cash secure put. Now, as for what DTE and what delta to choose, generally for the wheel strategy, I like the DTE sometime around a week or 2 weeks, right? Because the whole idea here is that I actually want to get assigned, right? I want to get into the stock position, and then if the market goes up, I'm going to get capital gains on that as well. And also for the delta, I like to actually choose somewhere around at the money, right? Because again, like I mentioned, I want to get assigned. So that is why at the money have the higher chances of you getting assigned, right? Too many times you see people get into the wheel strategy and then they sell a delta that's so far away, right? Maybe like 20 deltas or even 10 delta, hoping to just get the premium, right? The thing is that yes, you get the premium, but that's only because maybe the stock has already shot up all the way, right? It may have come down a little bit, and maybe your 10 delta or 20 delta is somewhere here, it didn't touch here, and it goes all the way up, and then you only get the premium. But had you been assigned the stock, you would have actually captured this move down here, which you get the capital gains, which is going to be a very big part of the amount, the profit that you're going to make from the wheel strategy, right? So that is why I like to go somewhere around where the current market price is, somewhere around at the money. Hopefully, I do get a sign. Market comes down, and then if I do get a sign, market is going to go up. Now, if I don't get a sign, then I'm going to just sell the put option over and over again until I get a sign. Now, as for the exit, then it's going to be the opposite, right? I'm going to wait until the stochastic is in the overbought region, and then I'm going to start to sell my covered call. Now, the other way is that if you want to take a longer term stance, whereby you want to wait until the valuation price has been hit. So as you can see down here, this is Google. So Google valuation is, I think, somewhere around 200 plus. So what you could do is that once you're assigned, you could also wait until the price go all the way until past the valuation price, then you sell the cover call. So if you do that, then you're going to get a much bigger capital gains. But at the same time, you have to be prepared to be, this is going to be less active kind of trade, right? That means you're just pretty much going to hold the position until it goes up. But if you want to take a little bit more active approach, then you can just simply sell the cover call once it's overbought. And then once it come all the way down again, once it's oversold, then you sell the put option again, and then you rinse and repeat. Okay, so this is method number 1. Now, method number 2 is the income grid wheel strategy, and this is where you have multiple entries. So I've already talked about this in a separate video, very much more in-depth, but I'll just go through the overview here. So if you want to go more in-depth into understanding what this income grid wheel strategy is, just go to my channel and just type income grid wheel strategy. So for this method, for the entry, we're pretty much just going to stagger the cash secured puts, right? So you can do this according to, fixed price intervals. So maybe every $5, $10 or whatever it is. And the other way is to stagger them by percentage level. So maybe each level would be a certain percentage apart, maybe 5% apart or 3% apart, so on and so forth, right? So basically you want to have multiple levels. So you are not too concerned about the timing, because we know that the market in the long term, hopefully it goes up, right? Especially according to the 4 golden rules, which we have already chosen the stock. So we've already done the due diligence on the stock part. Now, in terms of the timing, we don't really have to be too particular, right? Because once the market comes down, we will just sell the cash secured put. The next level again comes down, then we sell again. So we sell one by one. And then once we get filled, On the way up, we can also sell the covered call as well. So for this, I don't really take a look at the stochastic, but if you want to as well, you can. Maybe, for example, if it comes down to the oversold region, and then you want to start doing the levels, staggering your cash secured put, you can as well. So for the exit, same thing as well. You want to stagger your covered calls on the way up. So for this, you can either wait until it's overbought and then you start to sell the covered calls. Again, once, for example, if at this point it's overbought, you sell this first covered call. And then once it goes past this covered call, you can sell the next one and so on and so forth, right? So again, I've already covered this in another video. You can go to my channel and search for the income grid wheel strategy, explain it much more in detail there. So the other way is that you can wait until it's over the valuation price. So again, wait until the market has gone all the way up to about $200 plus, then you start to sell the covered call. So for this, no right and wrong, really comes down to how active you want to be, right? So the only difference between method 1 and method 2 is the capital intensiveness, right? So method 2 is going to be a little bit more capital intensive. So you definitely need to have a much bigger capital, but if you don't have that much of a bigger capital, then you can go for method 1. All right, guys, so these are the 3 stocks that you can use the wheel strategy on, and I've been reeling them for quite some time. It has been doing very well for me, so definitely do try them out using either method 1 or method 2. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. Alright, back to the video.